Good morning, everyone. Welcome live to Zinc today at beautiful Federation Square in Melbourne for our 2021 Federal Budget Breakfast. My name's Stuart Dowell, partner in charge of our tax advisory team here in Melbourne. Before we begin, I'd like to take a moment to acknowledge the traditional owners and ongoing custodians, the Aboriginal and Torres Strait Islander people of the land on which we all meet today, and pay my respects to their elders, past, present and emerging. Great to see you all here, and welcome to our thousands, I think it's thousands, of viewers tuning in for the live stream of this event. We're recording the event today, so if you want to enjoy it a second time around, or perhaps share it with your family and friends, we'll be providing a link to all those who are registered shortly after this morning's event. So why are we here this morning? Well, we're delighted to host you all today to provide our analysis of the federal budget and what it means for you, our clients, and Australia's middle market. We make it our business to know the issues and challenges of your businesses, and to that end, we have assembled the very best expert speakers there are to share their views and analysis on the federal budget from an economic, tax and business perspective. More about our speakers in a moment. Set amidst the pandemic response and recovery, albeit with share markets that are hitting a new record high earlier this week, I'm sure there isn't much surprise in this room or with the online audience that the focus of the budget is on continuing to support the economic recovery. But did it go far enough? Are we still in rescue mode or recovery mode? It's got a relatively short-term focus on spending, and that'll undoubtedly create some opportunities, which is great, and we'll talk about them more this morning. Challenging as it is, we would have really liked to see it go a little bit further in setting out a longer-term plan for policy direction that'll encourage businesses to continue to invest in growth going out into the future. Ahead of Tuesday night's budget, back in February this year, in Pitcher Partners' pre-budget submission, we argued that a revival of plans to reduce the corporate tax rate more broadly would have freed up critical cash flows and encouraged further business investment. Little did we know at that time, in the intervening period, both Joe Biden in the US and Boris Johnson in the UK would confirm and announce their plans to go the other way, winding back the significant corporate tax rate reductions those countries have implemented over the past decade or so. But while some might say the actions of our friends, the US and UK, is good enough reason to abandon any hope of a corporate tax rate cut here in Australia anytime soon, I think it actually remains a real possibility, or at least an opportunity for Australia. More an opportunity perhaps than a possibility. On Tuesday evening, hearing the Treasurer, Josh Frydenberg, talking about a range of specific micro measures to make Australia more attractive as a destination for international investment, which our tax speaker will talk some more about today, it was hard not to think what an opportunity that could have been, a real opportunity to really make some headlines around the world on corporate tax, put a stake in the ground and grab the attention of world businesses and investors by saying, we're going the other way. Put your money and your investment here. But maybe we'll talk about that later this morning, among other things. The format for today is that we have three very esteemed speakers, each covering their own areas of expertise: the economy, tax and business landscape. We've also set aside some time for QA this morning at the end of the session, where you can submit a question to our speakers. To ask a question, please use the QR code on your table, or for live stream viewers by using the link you should see displayed on your Zoom screen. Don't submit questions using the chat function, please do it using the link. Whether you're joining us in the room or on the live stream, all questions need to be submitted online, and they can be logged at any time during the event, and I'd encourage you to do that as we go this morning rather than saving them all up for the end. Quick piece of trivia, QR in QR codes. Does anyone actually know what QR stands for? It actually stands for quick response. Maybe I'm the only person who didn't know that until just before. Anyway, now we all know. As we're wrapping things up today, I'd ask you to also stay tuned for the prize draw. Everyone in attendance here and online, so no requirement to drop business cards in a bowl. Everyone in attendance here has automatically been put into the draw for a couple of great prizes we have on offer here today. So please stay tuned, don't drop off at the end, otherwise I'll have to accept you as proxy and you might never see your prize. So, introducing our speakers. For an economic analysis of the budget, we'll be hearing from economist extraordinaire Catherine Birch. Catherine's a senior economist in the Australian economics team at ANZ. She provides analysis on labour market, business and infrastructure investment and the broader Australian economy. Prior to joining ANZ, Catherine worked as a senior policy advisor and economist for the Victorian Government, an environmental economist at one time for the Namibia Nature Foundation, and an economic analyst for Oxford Economics. Following Catherine, we'll hear from one of my partners, tax wizard, Brian Farrelly. Brian is a partner at Pitcher Partners who specialises in tax advisory services, particularly income tax for corporates, trusts and large family groups. He provides services to a broad range of clients, ranging right through from startups to large multinationals. Brian will update us on the initiatives and tax changes coming out of the budget and no doubt some good tips and insights into how they might impact you and your businesses. Speaking of business, we'll hear from a man who really does mean business. Mr. Paul Gera he's the Chief Executive of the Victorian Chamber of Commerce and Industry. Sure, many of you will have heard Paul speak before, at least on some nightly news bulletins, or 2 or 3 or 4 or 5, I don't know what number you're up to, Paul. The number of TV appearances over the last year, Paul, I think you might be challenging Eddie Maguire for being Mr. Everywhere. He really does a huge job advocating on behalf of Victorian businesses. That's Paul, not Eddie. And I know he and his team at the Chamber will have been dissecting the budget and what it means for his members and the broader community since Tuesday night. So, without further ado, it's my great pleasure to introduce our first speaker for the session today. Please join me in welcoming Catherine Birch to the stage.
Thank you very much, Stuart. I don't think I've ever been described as an economist extraordinaire before, so I'm going to put that on my bio now. Let me make sure I know how to work these slides. I do. Okay, so budget. Budget week is really economist Christmas, really. So although it's a week of sleep deprivation, it's also a very exciting week. We were expecting an expansionary budget. We didn't expect it would be as expansionary as it actually was. So that does mean that there are upside risks to the outlook, and it will actually do little to dissuade the market from thinking that the RBA is going to lift rates earlier than 2024 when it's currently saying. Just picking up on Stuart's point as well about that lack of longer term certainty about the policy outlook. I think that's a really good point. Even though there is a lot of additional spending in this budget, and it is a bit of an election budget, I guess you could call it. We know that this isn't going to be a permanent thing for the current government. We know that at some stage they will return their focus to fiscal repair. And given that some of the fiscal deficits are now going to be larger than we were expecting, for example, the fiscal deficit in 24-25 is now projected to be 57 billion. That means that job of fiscal repair is going to be harder than it would have otherwise. And there are, apart from growing the economy to reduce your debt to GDP ratio, there are 2 big things you can achieve fiscal repair by. One is tax increases, which probably not going to happen with the current government if they do win the next election, and the other is cuts to spending. So that's something that we'll be keeping in mind over the next few years. I'm going to talk about 4 key things from the budget on Tuesday night. 1, the additional spending. 2, what it means for business at a macro outlook. I'm not going to step on Paul's toes. what it means for the economic outlook, and fourthly, where it leaves the government's debt position. So as I said, much more spending than we thought. We're also already in a much better fiscal position than we're expecting, even at MyEFO in December last year. And a big reason for that is the economic recovery. So you can see the blue bars on this chart is the improvement in the fiscal position due to the stronger economy that we have now. And that's largely due to a couple of things. One, iron ore prices around $200 a tonne is always pretty handy. Two is that we've got a lot more people back into work, a lot more businesses going better and earning more revenue, which then flows through to tax revenue for the government. But these yellow bars are the policy changes that we saw in the budget and how they've affected the fiscal position. So over the 5 years from 2020 to 2021, we were looking at a better fiscal position worth about $104 billion over the 5 years due to that better economic position. But the additional spending almost completely offsets that with about $96 billion worth of additional spending. Now, usually in a budget, infrastructure is one of the headline areas of spending. That was not really the case this time. There's been a bit of a shift. Although there was the announcement of $15.2 billion in infrastructure spending over the next 10 years, most of that is not going to happen within the forward estimates. So most of that is going to happen post-24-25. So there's not that same focus. Also, some of that spending is for projects already underway that just need additional spending due to higher costs and things like that. But we saw a bit of a shift, more of a focus on services spending this time. So we saw aged care, $17.7 billion there, mental health, childcare, the NDIS as well, additional spending there. So that is quite a different shift from what we would usually see, but we think that's a really important shift as well. One of the areas that the government is really looking to stimulate is productivity. And usually we think about investments in physical infrastructure as being able to grow that productivity level. But actually, if we look at a key report from the Productivity Commission a few years ago, they've said, well, if you look at the Australian economy now, there are far more people and far more businesses and industry in the services sector than there is in manufacturing and construction and things like that. So infrastructure or investment is also should be directed towards social infrastructure, because investing in people means that we have more educated people, more skilled people, and we can get productivity gains that way. A couple of other things that we saw on the spending side. So, for example, the extension of the low to middle income tax offset, which, again, from a macroeconomic perspective, is a good thing. Because it will continue that additional income going to low to middle income households who tend to spend more of every additional dollar that they get compared with higher income. So because we've got this $96 billion in additional spending, almost offsetting the $104 billion in a better fiscal position, the fiscal deficits going forward actually aren't too much different from what we're expecting, and actually going to be quite a bit larger. And so that goes to the point before about, the government is going to get to a point where it starts to shift focus to fiscal repair. It has said it wants to see an unemployment rate in the 4s before it does that. But at that stage, it's going to be a harder job because those fiscal deficits are going to be larger than they would have been otherwise. So what does this mean, or what does the budget mean for businesses at a macro perspective? So again, one of the things that the government has really been trying to stimulate is business investment. And this has been a bit of a weak point in the economy even before the pandemic. So since mid-2018, business investment has actually been falling. And that means not only in the near term do we get a smaller contribution or actually a detraction from growth, but it means that in the future we're going to have a smaller capital stock, which means lower productivity as well. So we've seen a number of measures introduced last year as well. So the instant asset, boost to the instant asset write-off and then temporary full expensing. We've seen in the budget $20.7 billion to extend temporary full expensing and the temporary loss carryback as well. And the government thinks that actually this is going to be quite effective at boosting investment further. And what we're seeing in the data says that actually this has been quite effective. So in Q4 last year, we already saw business investment start to turn around and have a positive quarter for the first time in quite a while. The government is now expecting that in 22-23, non-mining business investment will increase by 12.5% over the year, which would be a huge achievement if we got there. And that will start to reverse some of that trend that we'd been seeing before the pandemic of capital shallowing, which means that, a bit of an economic term, but it means that workers have less capital to work with, so are less productive. And actually before the pandemic in 18-19, we saw labour productivity fall for the first time since that series began. So what does the budget mean for the economic outlook? Well, actually, if you look at the Treasury forecasts, they do appear to be quite conservative. Even with all this additional spending and the better starting point for the economy, the Treasury only expects that the unemployment rate will come down to 5% by mid-2022 and then 4.5% by mid-2024. We're a lot more optimistic, and that was even before this additional spending we saw in the budget. So we're expecting an unemployment rate of 4.4% by the end of next year. We've seen very strong employment growth already. And there's a couple of other factors that are going on when there's so much demand surging at the moment, while we still have border closures as well, while there's a bit of inefficiency in labour market matching for a number of reasons. So we do think that we are much more optimistic. Also the same on wages growth. So the government or Treasury are only forecasting wages growth of 1.5% by mid next year, and only getting to 2.75% by mid-25. And this is comparing it with the RBA, which wants to see wage growth of above 3% before it can be convinced that inflation is going to remain in the target band of 2 to 3%, which is the requirement they want before they start to think about lifting rates again. So there's a bit of a disconnect between those expectations there. We think that actually there's a lot of upside risks to the government's current forecast, and that's actually going to be a good sign for the fiscal position as well if it does eventuate. So, for example, if we do get unemployment rate down more quickly, if we do get higher wages growth, workers will be earning more, there'll be more workers as well, which will add to the tax revenue. And just again quickly on iron ore, the budget generally assumes that the iron ore price will go back down to $55 a tonne and stay there for the outlook. That's their base assumption. It's currently sitting around $200 a tonne, and although it may not hang around where it is for too long, it's probably going to be well above $55 a tonne for a while. So again, that's upside risk. I'll just finish with a bit of discussion on the government debt position. So net debt is going to continue to rise quite quickly, not quite as quickly as we were expecting because of that better position we're in now, but it still will rise quite quickly. So it looks like net debt will peak at almost 41% of GDP in 2024-25, up from 30% in 2020-21. Now, when we think about debt as economists, we're mainly thinking about can we service the debt and also what is the debt going towards. So on that second point, if we are investing in things that are going to give us longer term gains and add to productivity, that means that the GDP will grow more quickly, our debt to GDP ratio will come down more quickly. Excuse me. But the first thing, being able to service our debt, well, actually that's pretty easy at the moment because we've got such low rates. So over the forecast horizon, the cost of servicing that debt is likely to remain below 1% of GDP, so very manageable. But we have seen bond yields rise this year, And if that global economic recovery continues and bond yields do rise further, that will put upside risk on those servicing costs there. So I think the key thing is to make sure that we're investing in the right things now that will get us a good return in the future, and will make it worth all this additional spending that we're seeing now. I'll leave it there. Thank you.
Thank you, Catherine. Fascinating insight into the state of the economy. Appreciate it. My name is Brian Farrelly, a partner at Pitcher Partners here in Melbourne, and it's my pleasure to be here on this beautiful sunny Melbourne morning to provide an overview as well as some specific insights into the various taxation measures arising from the budget on Tuesday night. Look, many of the measures are expensive but temporary. As we continue to recover from the economic impacts of COVID, these measures should provide some stimulus and support for the recovery. There are other more targeted measures with a long-term focus, but there is little in here by way of structural reform, which I'll go through today. So what will I be covering? Firstly, an overview of the taxation measures from the budget. Secondly, talk through the measures relating to individuals, then business, and international, and some other measures. Well, if he said it once, he's said it 1,000 times. It's all about jobs, again. The mantra was prominent in Josh Frydenberg's last federal budget, which was only 7 months ago. And as the unemployment numbers provide support for the government's plan, it is clear that the focus on jobs has driven many of the spending initiatives from Tuesday night. In addition to some of the tax measures that I'll go through, there are significant infrastructure investment, expanded apprentice funding through Job Trainer, all designed to boost jobs to get to the desired sub 5% unemployment rate. But what was in the budget from a tax perspective? Well, there was little in the way of big surprises. As with all recent federal budgets, there were plenty of leaks prior to Tuesday night, and only a few announcements on tax on the night. High spending, funded largely by debt, focused on aged care, infrastructure, low and middle income tax earners, and investment incentives. What Tuesday night did surprise us with is government predictions on some certain assumptions used for the budget. Vaccine rollout to complete by the end of the year. Overseas travel not to return until after mid next year. Wage growth to stay stagnant over the next few years and population growth to be largely non-existent until 23. But with the prospect of no further federal budget before the next election and all that spending, it is clearly an election year budget. What was missing? Well, plenty. No changes to the corporate tax rate. As mentioned by Stu, this is an important change that Pitcher Partners continues to advocate for. No changes to personal income taxes, just a maintaining of the current rates and the current offsets. No GST changes at all. No changes to the legislated super guarantee rates, which were discussed quite heavily in the media leading up to Tuesday night. The rate will increase to 10% from 1 July this year and 5.5% each year after until 12%. Overall, no structural incentives or long-term tax reform. So looking at the tax measures for individuals. The main one here is the extension of the low and middle income tax offset. Now this effectively rolls forward the current offset in place for FY21, which provides for an offset of up to $1,080 per taxpayer. It impacts over 10 million taxpayers. It is not a tax cut, it's a rolling forward of an existing measure. And I guess it avoids the media talking about it as a tax hike had the government not spent a $7.8 billion required to keep it in place for another year. Combine this with the increased tax rate thresholds that were introduced last budget from 1 July 2020 under stage 2, and there's clearly a reasonable benefit that will apply to many taxpayers over the next 14 months. This should help drive stimulus and growth. There are a few other changes to assist with housing affordability. 10,000 homes for single parents requiring only 2% deposit subject to certain criteria. An extension of the new home guarantee for another 10,000 homes in FY22. Again, this one requires only a 5% deposit subject to criteria. and the government also increasing the maximum realisable amount out of the first home superannuation saver scheme from 30 to 50,000. These initiatives, along with the extension of the home builder construction commencement period, should support the residential construction sector further. Okay, there's a lot of numbers on this page, but what I'm just setting out here is the individual tax rates for next year, FY22, as well as the following 3 years. The key points to highlight are as shown, which is really that the low and middle income tax offset will come off from FY23, and the stage 3 personal tax plan is currently designed to kick in from FY25. Now, there was some talk in the budget, leading up to the budget around whether the government might look to bring forward the stage 3 tax cuts, as they had done with the stage 2 cuts in the last budget. However, given that the stage 3 disproportionately impacts and benefits higher income earners, it is not surprising that nothing was done here at this stage. A point to note, given the projected deficit for FY25 of nearly $1 trillion, there may be some hesitation with locking in the stage 3 rate cuts in 3 years' time. On super, a few changes here just to help boost the balances for lower income earners and those entering retirement. There's the removal of the $450 per month minimum income for superannuation guarantee payments. This change will impact around 300,000 lower income earners, Treasury forecasting that 63% of these being female. The downsizer concession allows those over 65 to contribute up to $300K into their super fund on disposal of a home they've lived in for 10 years. This has now been expanded to apply right down to the age of 60 years. The work test has been abolished in order to make super concessions contributions for individuals aged 67 to 74, but this only applies to non-concessional contributions. These above tests won't come in place until after we're all sent to the legislation, which is expected not to be just prior to 1 July 22. Finally, on individuals, pre-announced measure, changes to the childcare subsidy to help support parental choice. For many of us, the high cost of childcare services is all too real, so I expect this one to be closely watched. The proposal is a boost for the maximum subsidy for childcare services of up to 30%, right up to 95% rebate. The boost is actually only for the second and subsequent child of a family, and both children need to be in childcare and both children need to be 5 years or under. Not sure how this will play out with respect to a potential baby boom, but families may consider the age between 2 kids as they consider the subsidy going forward. The removal of the current annual cap of $10,560 per child is only for families it's only currently in place for families with a family income over $189K. So this is really likely to benefit the higher income earning bracket, mainly for childcare of 4 more days a week. Changes here are not effective until 1 July 2022. On the business side, there's 2 key measures to raise here. The first is the extension of the temporary full expensing measure, which allows entities up to $5 billion in turnover to write off expenditure of depreciating assets in the year it is first installed or used. So the existing measures were announced in the federal budget 7 months ago and were due to cease in 30 June 22, but the announcement extends this for a further year. Now, this is a large portion of the total expenditure in the budget. Measures at $17.9 billion for this increase alone, which surpasses the increases to aged care spending of 17.7. The benefit of this extension is that businesses now have a clear window of more than 2 years to make longer term plans for major investments. The same eligibility rules apply to these concessions as continues to apply up for the period up to 22. And importantly, just to highlight, so there were some changes to these rules introduced in December, which allows an opt-in or opt-out on an asset-by-asset basis. The watch out here is that in the current year, in FY21, there's a number of crossovers. We've got 2 different instant asset write-off regimes. We've got the full expensing regime. It can be quite complex with respect to 30 June 21, so I encourage you to consider these rules, make sure carefully they've been applied correctly, and also obviously take the opportunities from these measures. In addition to extending full expensing, the budget announced an extension to loss carryback rules. Now, these rules, also announced in the last budget, are only available to companies with And the idea here is the ability to carry back losses from FY20, FY21 and 22, carry them back to earlier years, FY19 onwards. The extension is to carry these rules out to FY23. The measure really goes hand in hand with the full expensing. It allows companies to continue to make significant capital investment right up to the end of FY23 with the ability to utilise any losses generated in FY23 when they lodge their tax return, rather than having to wait until those losses are utilised over future years. There are still the same watch-outs with these rules, in particular with relation to having sufficient franking credits to claim the tax refund from earlier years. It's been another burst of talk of innovation and technology with the digital economy strategy. I'm reminded of Malcolm Turnbull ushering in the ideas boom back in December 2015, or Kevin Rudd's version of the digital economy promoted in 2011. And Scott Morrison has been busy promoting these measures over the last week. There is a patent box regime whereby medical and biotechnology innovations are charged a flat 17% tax rate on income on new patents. While this is still subject to consultation, it's a welcome step and is similar to regimes in Singapore and China and France and the UK. Also, taxpayers will now be able to self-assess the tax-effective life of eligible intangible depreciating assets, rather than use the ATO prescribed lives of up to 25 years. This measure covers patents, registered designs, copyright and in-house software, and applies to assets acquired after 1 July 23. This then coincides with, up until then, we've got the temporary full expensing, and after that, the new self-assessment for intangible assets kicked in. And finally, a 30% tax offset for digital gaming industry on qualifying Australian games expenditure for larger businesses in this space. So a welcome move in that industry. A couple of small changes on employee share schemes. There's the removal of the cessation of employment as a taxing event on tax-deferred employee share schemes. This will assist companies in offering ESS to employees that may subsequently cease employment. It allows employees not to be taxed provided that the other tests continue to be satisfied at that point in time. There are also some regulatory improvements to the ESS regime related to some disclosure requirements as well. International tax. A few measures to talk through here. Firstly, the announcement of a bright line test for determining an individual's tax residency in Australia. So this provides greater clarity, with the existing rules being a little bit more complex. The new primary test should be more straightforward, with individuals physically present in Australia for 183 days or more in an income year being treated as tax resident here. Now, you may recall the government announcing new residency rules in relation to corporate entities at the last federal budget. An update was provided on Tuesday night, broadening the consultation on these rules to also cover trusts and corporate limited partnerships. A welcome addition. There's finally one more there. Yep, sorry. And of course, with many sporting teams from New Zealand, sorry, as a Kiwi, I should say world's best sporting teams from New Zealand, spending plenty of times here at the moment due to travel restrictions. An announcement on Tuesday that New Zealand will retain their taxing rights on these athletes and support staff. Some other measures of note are shown here. Not-for-profits will soon be required to furnish information to the ATO on an annual basis to support their tax-exempt status. Technical updates to the TOFA regime in relation to the hedging election to keep these rules up to date with changes in accounting standards. An announcement for those involved in the funds management sector, an important announcement relating to the corporate collective investment vehicle regime. This will be finalised with effect from 1 July 2022. It's long awaited and follows years of consultation, so we look forward to seeing the legislation in this space. And finally, and a good one to end up on, brewers and distillers are receiving a tax bonus. From 1 July 21, eligible brewers and distillers receive full remission of the excise they pay up to $350K. Currently, eligible brewers and distillers are entitled to a refund of 60%, up to an annual cap of 100K. So cheers to that. Key takeaways. Just to summarise, the key takeaways for individuals: tax rates, offsets are remaining in place for FY22, small changes to superannuation to boost savings, and we look forward to seeing the childcare subsidies in place from 1 July 22 to assist return to work. On business, an extension for a further year of full expensing on lost carryback up to 30 June 2023, targeted measures for the digital economy, and on international, the simplified tax residency rules for individuals and the expansion of the corporate tax residency consultation to cover trusts and limited partnerships. I'll leave it at that. Thank you very much, and I'd like to invite Paul Guerra to the stage.
Thanks, Brian, and thanks, Stuart, for that very warm welcome. I do apologise for all the TVs I've broken over the past 12 months, sincerely. Good morning, and thank you for having me here today. Stuart mentioned the quick response code, so if you haven't already, those in the room, can you make sure you check in, please? It's really important we get into the habit of doing that as well. And I acknowledge the traditional owners and pay my respects to their elders, past, present and emerging. Very special thanks to our valued Victorian Chamber member, Pitcher Partners, for hosting me today. Brendan, we just love working with you and the team, and it's an absolute honour and delight to be here with you today. To Scotty Benker from my team as well, welcome to you, Scotty, and the table that you're hosting over there as well. We know the relationship between the Victorian Chamber and Pitcher Partners is strong. It's not only strong, it's rewarding, and I think it continues to go from strength to strength as well. Now, I can't claim to have anywhere near the expertise in economics and tax as Catherine and Brian. Brilliant presentations to both of you, thank you. Love ending up on the spirit side as well. It's quite an interesting one when you think about spirits and then also the gaming side. It does make you realise how far our economy has come in terms of the diversification of it as well. I'll try to break down what it means for businesses in this state based on the three pillars that we had for advocacy, which is around enabling business, growing business, and then ease of doing business. We knew a fair bit about what was going to be in the budget before the Treasurer got to his feet on Tuesday night. We read about the infrastructure upgrades and the childcare rebates on the front pages of the daily papers over the past probably fortnight or so. It's funny, I heard an economist on radio on Tuesday saying that government is the only vessel that leaks from the top. It continues to do so. Our initial reaction on Tuesday night was that this was a bounce-back budget, which will boost the digital economy, it will boost skills, and it will boost jobs, and it will make the workplace more appealing for women, and that will all help in assisting our recovery from the COVID-19 pandemic. Quite incredible when you think about where we were 12 months ago and the forecast for what the economy was going to be, that what was announced on Tuesday night with the way that the economy has come roaring back, we're in quite a remarkable position, I think. And things are looking great in Australia, there's no doubt about that. When COVID-19 hit, there are predictions of double-digit unemployment rates. On Tuesday night, and Catherine's reinforced it today, we heard that the unemployment rate is at 5.6% and is forecast to fall below 5% by late 2022, while the economy will grow by 5.25% in 2021 and then 2.75% in 2022, having outperformed every major advanced economy in 2020. It's a remarkable effort. Last year, the budget was about survival, about us getting it through. You think JobKeeper and you think JobSeeker, and they were just landmark initiatives that I'm sure we're going to reflect on in years to come. But it was about keeping as many people in jobs, as many people connected to their businesses, and as many businesses as possible up and running, and importantly, as many Victorians as possible with an income. The Treasurer's comments on Tuesday night around business left me with every confidence that the people at the top understand and appreciate the role that you all play in Australia's prosperity. Treasurer Frydenberg celebrated business as not only the engine room of our economy, but also the heart of our community. And you are. As business leaders, you are. Business provides jobs, it drives innovation, it contributes to our enviable lifestyle and culture. You're the sponsors of local footy clubs and donate to the local school fundraisers. Government knew how much they needed business to survive the peak of the pandemic. Now they know how much they need us to thrive, the economy to thrive. And that's what I'm going to focus on today. The elements of the budget that excite me because they're all about future-proofing our economy and creating meaningful paths for women and our young people to take the baton from today's workforce and then sprint into the future. Some of us will understand that in past recessions, it was exactly the female the youth and the elderly and nearing retirement that were the most disaffected. So to focus on the females and the youth, we think is absolutely appropriate. It struck me on Tuesday night, and probably more yesterday, that this budget is all about harnessing the talent, skills and assets that we've heard about. It's about maximising what we know and building on our strengths. We know, and I think with some trepidation, that the borders, international borders, won't open for some time yet, and international travel won't resume to pre-pandemic levels until 2024. Bit of a scary thought, I must admit. So in order for our economy to fire, we need to make the most of what we have right here at home. There's three things that we'll focus on, and that's upskilling, training, and encouraging workplace and business participation. The second is practical and workable measures to address the skills gaps. And third, prioritising Australia's intellectual property and adoption of technology so we can be a world leader in innovative manufacturing. The federal budget will activate business by providing support for the skills required, with $6.4 billion to ensure that Australia has the skilled workforce to grow post-COVID-19. One vital tenet of the commitment is $2.7 billion to extending the Boosting Apprenticeship Commencement program to support 170,000 new apprentices and trainees by offering employees a 50% wage subsidy over 12 months. Not many of you may be aware of the prominent role that the Victorian Chamber plays in this space. The Australian Government engages us to deliver high-quality apprentices and trainees through our apprenticeship support program, which is a major component of our business. In fact, we are the largest provider of apprentices and trainees in the state. Last year, the federal and state governments recognised the need to arrest declining new apprenticeships and traineeships numbers, as well as the large number of cancellations that occurred when COVID-19 hit, by providing wage rebates and incentives in their respective budgets. Our data from apprentices shows that more than 45,000 apprentice and traineeships across Australia were cancelled or suspended at about this time last year. These positions were the first to go when the on-site positions are at a premium. There are 500 qualifications and pathways available to apprentice and trainees space, including building and construction, childcare, agriculture, hairdressing and hospitality, and I could go on. Boosting Apprenticeship Commencement program created 100,000 apprenticeships and traineeships in 5 months from March 2021, with the Victorian Chamber playing a role to assist 40,000 businesses to employ apprentices and trainees at that time. That's 8,000 bricklayers, 6,000 electricians, 11,000 people in retail and hospitality. It's a big number and a good number. We've had our busiest period on record, which demonstrates that the green shoots that the economy is showing and the new jobs, skills and pathways that the government policy is helping to create. The boost for apprenticeships is something that we see a growing demand and need for in Victoria, and we're pleased to see this investment in our workforce of the future. It's not just about jobs, it's also about having the right skills available as well. From the 5th of October last year to the 31st of March this year, 5th of October last year to 31st of March 2022, businesses of any size can claim the Boosting Apprentices Commencement Wage Subsidy for new apprentices or trainees who commenced during that period. Eligible businesses will be reimbursed up to 50% of an apprentice or trainee's wages of up to $7,000 per quarter for 12 months. In addition, for the funding for apprentices, the federal budget included $500 million to expand the Job Trainer Fund, providing free or low-cost training places, again in priority sectors. And more than $1.7 billion has been allocated to make childcare more affordable. The change is expected to boost the level of GDP by up to $1.5 billion per year. There's a lot in the budget to encourage female participation in the workforce and in business. We've all read a lot about this. In short, it's needed, and we hope it will have a significant impact, particularly incentivising women to break into the non-traditional trades. As we know, the private sector always leads government policy, and we have seen these traditional conventions that once stifled our economy break down for some time now, and it's great to see public policy play its role to continue that prioritisation and progression. COVID-19 has impacted some sectors more than others. There's no doubt about that. When you think about events, tourism, hospitality, international education, and some parts of manufacturing among them. And we're constantly hearing reports of businesses in many sectors struggling to get staff. In some cases, it's a matter of skills and training of the individuals not meeting the requirements of the role that's currently available. This budget includes practical and workable measures to address some of the unique challenges businesses in those industries continue to face. They include removing the 40-hour per fortnight work caps for student visa holders employed in the tourism hospitality sector, and expanding the COVID-19 pandemic event visa for 12 months for people again working in the tourism and hospitality sector. This is a common sense approach which enables non-Australian citizens who are already here to continue to play their role in the economy and take on some of the jobs that employers are desperately trying to fill. Not to mention providing these students and workers with an income, as the vast majority won't be eligible for government support, and you can only imagine the negative flow-on effect that disconnecting their revenue stream would have had. Finally, I'm excited about what the government had to say, and that's already been touched on, around future-proofing our industries and giving our world-leading medtech and biotech industries the recognition they need to lead the world with the next bionic ear, or perhaps a cervical cancer vaccine. I heard Craig Watman from Pitcher Partners on the radio on Wednesday morning, and he sounded as pleased as me about the patent box scheme. But I reckon, aside from maybe Nigel from CSIRO who's in the room today, we may be in the minority there. I must disclose that I'm an electronic engineer and I'm also involved as a non-executive director in 2 startups utilising AI at the moment as well. What it means is that the government is providing tax cuts on intellectual property, which will allow for greater investment in innovation and commercialisation. Brian touched on it before, but the patent box scheme offers a concessional corporate tax rate of 17% on taxable income derived from Australian patents in medical and biotech sectors. Effectively, you'll be paying a lower tax rate to trademark the brilliant ideas that generate from Australia. May seem intangible to most of us, but we will all be winners in the long run from this when you think about organisations like CSL and what they've done over the journey as well. It'll have a massive flow-on effect for our smart sectors, which will see us to continue to rise as a global superpower in the space and secure an industry for the future, which means more jobs and greater prosperity. Great thing about this for Victoria, as we are the Australian leaders in medtech and biotech, so I expect that to continue through this announcement as well. The budget also provides $300 million to support exporters and businesses with freight assistance, to support to diversify and to expand to export markets. 3% of Victorian businesses currently export. 3%. So there's an opportunity certainly for further recovery in that space as well. COVID-19 accelerated many businesses' adoption of technology and digitisation, and it's great that the federal government will provide programs and incentives to enable businesses to take advantages of all that innovation and artificial technology has to offer. The digital economy strategy includes $1.2 billion to transform Australia into a leading digital economy by 2030 and overhaul the government's online services platform to ensure the nation remains globally competitive. This includes $124 million to boost the country's artificial intelligence capability and to establish a national AI centre led by the CSIRO. $500 million enhancing the government's MyGov, My Health Record and digital identity system. Boost for small and medium businesses to drive the uptake of e-invoicing. And $35.7 million for drones and emerging aviation technologies, which I think furthers into the space around gaming and even to some of the startups in the spirit industry as well. I'll add that, importantly for business, and an area that the Victorian Chamber has been strongly advocating for, is an extension to the temporary full expensive and temporary loss carryback, with both now extended to 2023. And again, Brian's touched on that as well. There's always a but when it comes to the budget, and we think there were probably 3 areas that were possibly missed out of it. The first is the lack of funding for purpose-built quarantine facilities in all Australian states, so that we can start opening up our borders and further boosting our economic recovery. The second was a lack of support to universities to bring back international students and fund the gap created in research and development and in innovation and the commercialisation of those ideas. It will be impacted if we don't get international students back. And the third is more substantive support for small tourism providers who will continue to be severely impacted by the lack of international travellers while Australia's borders effectively remain closed until about mid-next year. But in all, it was a good budget. It was a business-orientated budget, and it's a budget that's appropriate for the time. Our attention will turn to the state budget next week, where we'll continue those themes of enabling, growing and improving the ease of doing business in Victoria. They're the cornerstones of our pitch. They were to the federal government and they also are to the state government as well. So with that, thank you. Look forward to taking questions later on. Thanks.
Fantastic. Thanks very much, Paul. Don't sit down because I'm going to invite the 3 of you to join me on the stage. So please welcome Catherine, Brian and Paul back onto the stage. If you'd like to come up and take a seat. We've had a few questions submitted online and in the room, but remember to scan your QR code or click the links if you're watching online to ask your questions. Catherine Burt, probably a question first for you. The iron ore, there has been a lot that's been spoken about that. Interested in your thoughts on the background or the drivers for the assumption around the $55 per tonne that's in the budget. Taking into account, and I think you touched on this, that when the last budget was handed down in October, I think $55 was the assumption then. Iron ore prices at the time were about $120 a tonne. As you said, it's up north of $200 a tonne now. Why is the government so conservative on that assumption? And I guess what's your view around the outlook for that?
As you said, it's really just a standard assumption that is made in the budget, which is a conservative assumption, and that's the way that they like to factor it in. Because it is a commodity price, it can move around quite quickly. As we saw, even a few months ago, no one was really expecting that it would be up around $200 now. So it's really just taking that conservative stance, and any upside in the price just means that it's going to be a positive for the budget position, really. We're not expecting that it's going to hang around the $200 mark for too long. We have been surprised that it has reached that though, so there is obviously upside risk to that. But we do think it will remain well above that $55 a tonne assumption. A few reasons that's really driven the very high prices we're seeing at the moment. Well, one, there are still some supply issues going on, particularly with production in Brazil. 2, we've got on the demand side, obviously that's been picking up quite quickly too, and that's going to be quite supportive going forward when we think about some of the infrastructure stimulus, particularly in places like the US. 3rd, we've also seen China have more of a focus on reducing its emissions, improving the quality of its steel production and steel refiners as well. So that means that's also shifting the balance as to what type of iron ore they're demanding and how much capacity they have around that too.
Rick, I won't ask you, Catherine, for your thoughts on Bitcoin, because I think in the same time, back in October, that was hovering at around US $11,000, and earlier this week up nearly 60,000, certainly north of 55,000. I'm not sure there's a rational way to perhaps explain that for the people who are non-believers, I guess. Paul, you touched on this. Were you surprised? I think I know the answer to this question, but you can perhaps elaborate a little bit. Were you surprised and disappointed with the lack of any funding towards better quarantine settings?
Yeah, both surprised and disappointed. We need the international visitors to return. for various parts of the sector, not only from hospitality and tourism, but from a skills side as well. And equally, there's businesses that need to get to other parts of the world to expand their business as well. There's two things that are going to make it safe for people to return. We're enjoying a lifestyle in Victoria at the moment, which we want to keep. Right? COVID's at bay, aside from the scare we had a couple of days back, COVID's at bay here. So to keep it at bay, the only way we're going to be able to do that is have an effective vaccine rollout and effective hotel quarantine or quarantine facilities, as I think they'll move to. We thought that was the missed opportunity. We know hotel quarantining isn't working when you look at all the breaches that have occurred. The one that seems to be held up as working the most is a purpose-built, as it turns out, a purpose-built centre in Howard Springs in Alice Springs. I was talking to John Bazali earlier today. There'd be plenty of people in this room that if we were given, okay, we're going to do it, that would be able to jump in and provide cabins or outdoor type facilities that will enable quarantine to be done in an effective way that can still be close to hospitals, but keep the community safe by keeping the virus at bay. It's going to be needed if international travel is not going to return in substantial numbers until 2024. That means that we're going to need this for 3 years. Who knows how long we're going to need it, because we know the vaccine is effective, but it doesn't stop transmission, it reduces it. So it's likely we're going to need quarantining in some form for the next few years. So let's just get on and build it quickly. We thought there was the opportunity missed.
Yeah. While we're sort of not directly on the topic of quarantine facilities, but investment into infrastructure here in Victoria, one of the announcements in there was around the intermodal facility or intermodal hub. And I did note that was the expenditure tag there was a contingency. Do you want to tell us a bit more about what that is, what that plan is, and what the Chamber's view is on that in terms of its importance for the state?
Yeah, the dependency is on the state government putting money up with it, so it'll be interesting. I bumped into the State Treasurer in the street, I think it was Tuesday morning. His comment was, it was interesting that what was 100 billion over 10 years, a couple of years ago, has gone to 10 billion over 10 years, so $1 billion a year. So there's some concern over what that is there. I mean, ultimately, joint funding between federal and state has proven to be effective along the journey. We'd hope that that continues. The intermodal connection is another one of those, just strengthens what we're hoping to see out of the airport rail connection as well. So, you know, it's infrastructure for everybody, although as Victorians we get the majority benefit of it. It still benefits the tourism and the visitors from the other states that come down as well.
Brian, question for you. A number of the measures, a number of the tax measures are not due to commence until after 2022 or 2023. Is there a chance they won't eventuate? Do you have a view on that?
Well, that's always the risk. You know, ultimately it's a long-term plan. We're seeing that currently with respect to the stage 3 plan of the personal income tax changes. That's all been forecasted and put in the budget for FY 24-25. You know, what do we look like in 3 or 4 years' time? I think, you know, the budget's forecasting up to $1 trillion of debt. I think some of these changes, particularly the ones that cost a lot of money, are still up for discussion. And I suspect we'll have plenty of discussion over the next 12 months and beyond on some of them. Look, some of the key targeted measures that are due to come in 1 July 2022, would have thought they should be appropriately pushed forward without too much concern. It's those big ticket major reform and tax cuts, I think, that are still up for discussion.
While we're on the topic of tax, something that'll be close to your heart and I'm sure you're on top of is some of the recent changes that New Zealand has proposed around housing affordability and the impact that has on from a property tax perspective. Do you want to talk us briefly through that and potentially whether you see any property changes afoot in Australia anytime soon on the tax front?
Yeah, so I mean, from New Zealand's perspective, friends and family, we think we've got it hard over here with price rises. They're sitting at just close to 25% medium house increases in the last 12 months during the COVID year. And so the government there have simply just denied all interest deductions on investment to help kind of stifle that growth and stop speculative property investors from pushing the pricing up. Interesting, I think this budget on Tuesday night, there was very little in the way to assist with housing affordability. If anything, there was measures that would just increase demand. I think stimulus measures, appropriately so, given the recovery and position that we're in, but not much on the supply side. So, look, I personally, I don't see much happening in that space under the current government with respect to changes in property taxation. There was plenty of talk pre-last election. Labor have gone a bit quiet on those discussions and haven't raised them since around dealing with negative gearing and the like. So look, nothing in the foreseeable future, certainly not to the same extent as our friends back in New Zealand have seen.
Paul, have you got anything you'd like to add to that?
I probably concur with what Brian's saying there. I think we saw negative gearing put in a pocket at the last election, so I don't think that'll be touched again. There's speculation over why the house prices are growing at the rate that they're going, but when you consider it, and I heard the other day, $1 million borrowed at 2% interest rate. My math tells me that's $20,000 a year in repayment. So we're at an all-time low in terms of what it's there, and I suspect people are making the most of the opportunity that's there. Makes it harder for the younger kids to get into the market, there's no doubt about that, but I don't see any real way of stopping that demand growing while interest rates are where they are. And I'd have to say I'd rather see interest rates lower than perhaps where we saw them at the start of my career, which was about the 17% mark as well.
And Catherine, what about ANZ and your views as well? Where do you think housing will go? There are incentives to assist first home buyers, and the industry seems to be going well. So is that going to just push up prices?
Yeah, so our current forecasts are for housing prices to rise about 15 to 20% over this year, on average across the capital cities. So very strong, not quite New Zealand strong, but very strong. So far, it actually has been first home buyers that have really driven the initial surge in demand that we saw last year. And a lot of the government incentives have been to enable first home buyers to get into the market. Also, the extraordinarily low rates, not only variable rates, but fixed rates. So over the pandemic year, we saw variable rates fall, say, 70 basis points, give or take. Fixed fell 140 basis points. And that also gives people confidence that they can lock that in for the next few years too. Now, we think that the price growth will slow over the second half of this year, but still remain pretty strong for a few reasons. One, fixed rates will start to lift gradually now that the term funding facility is expected to come to an end in June. Also, we expect to see more supply start to come onto the market. So supply is still lagging quite a bit behind demand, which is why we've seen prices rise quite quickly. And actually, we think that we've already seen macroprudential tightening in New Zealand. We expect to see it in Australia as well. Not so much to address rising housing prices. I mean, really, the RBA wants to see housing prices rise because then you get a positive wealth effect. But it's more about that focus on the financial stability side. So that we think that if the Council of Financial Regulators starts to see lending standards deteriorate, for example, higher debt to income ratios, that's when macroprudential policy will likely be, or macroprudential tightening would likely be.
I've got another question on some of the budget assumptions, and you spoke about it earlier around the unemployment rate. So the question here is the government unemployment rate forecast conservative versus ANZ and the RBA to help them share good news in and around election day? What's your view on that?
Look, I think that's part of it. I mean, it's always going to be a good announcement if you're going into an election campaign and you can say, hey, we're doing even better than we were expecting because of all this stuff that we've done. So I certainly think it's part of it. And actually that will also mean that they would be able to announce smaller fiscal deficits, even with the additional spending. And actually, it also gives them room to say, well, we've been able to spend this now, and actually, because the economy has improved even more than we thought, we have a bit more room to spend too, if they do have some other spending commitments they want to make in the lead up to the election.
And Paul, you spoke a bit about jobs as well. Some employers are finding it really hard to find staff at the moment. So what are you hearing? Why is that so?
Yeah, we're hearing exactly the same thing, and it's across the board. We think it's a combination of things. People with the right skills in the wrong area, and that's brought about because there's still nervousness around moving away from your home state and not being able to get back in with temporary lockdowns and the like. There's no doubt international students that really make up a lot of the part-time and casual work that we have across the country. With those numbers, almost zero, it's been difficult to find people to find those works as well. There are some people that through COVID have taken a bit of a life change, have moved location, and the jobs that they once had they can't do from where they were. And if they've taken redundancies and the like, they're in no hurry to get back in to the workforce as well. So it's a combination, I think, of a whole range of things. We hope through the apprenticeship program, as more people are given opportunities, that's great. And we hope through some of the incentives that hopefully see a few more women back into the workforce, that can pick up some of that lagging demand as well. So I think it will continue, and it's curious in the way that has come about, because you would normally associate what we went through last year with more jobs being available, with more people available for it. But I think it also talks to the strength of the economy that we've got at the moment as well.
Yep. And another question for you, Paul. Given how badly the sector was hit across Australia by COVID, I didn't see any assistance for the broad arts sector. What happened?
Yeah, so I think you start. We've heard some support for the arts sector out of the federal government. I know the state government is trying to address that as well. The arts sector, like the entertainment sector, a bit like the events sector, for that to truly fire again, we need people back into venues. And until governments are brave enough to lift restrictions at a level that enables those particular venues to recover, they're going to need to continue to get ongoing support. We're expecting to hear more about that from the state government because one of the great things about Victoria, and one of the things that we're renowned for, is our arts and events sector, and we truly hope that they get support in the budget next week.
Another question here, perhaps I'll ask you this one, Catherine. Does the government have headroom to reintroduce JobKeeper, etc., if needed, and retain the full suite of initiatives in the budget?
Look, I think if you look at the initial estimates for JobKeeper, and if you take it from that sort of benchmark, well, they would have room. I mean, unless there would be another significant outbreak, which touch wood doesn't happen, that would require quite tight restrictions and lockdowns again, that meant that a lot of businesses would go back to where they were last year. I can't see JobKeeper being necessary. I think now it is a case of more targeted support, and we've talked a bit about the arts and tourism, those that are still very dependent on having lots of people or having visitors to Australia that really rely on that. So although if the worst happened and we did have to go into tight, widespread restrictions again, yes, they would have room. I would say that's fairly low probability at this stage, though.
Got a question here. It's always good to see one with lots of exclamation marks at the end, so I'll read this one. It says, aside from existing industries digging up dirt and making cappuccinos, do any budget measures stimulate new industries and new jobs, i.e. climate change? Exclamation mark, exclamation mark, exclamation mark. Paul, do you want to have a go at answering that one?
Yeah, I'll touch on it. Brian, I think some of the patent box stuff hits that as well, so I'll get you to touch on that. Yeah, it does. And Treasurer Frydenberg talked about, particularly that climate change or sustainable energy front. So it's an industry that, no question, will grow. There is support there in the budget for it. There's support for what we'd loosely call the digital economy, not only to enabling businesses move more into that digital environment, but Brian picked up the support for gaming, the support for the brewers and the distillers, and the state treasurer's already talked about some of the support measures that might come for that industry as well. So don't be surprised if there's something in there too. But the patent box part, which is really starting to take us into I guess more of a smart country territory as well, and there'll be a flow-on effects into all other industries, starting with the medtech and biotech, and they're trying to get that right first before they bleed that across. But Brian, I don't know what you want to pick.
Right. I mean, I think it'll be interesting to see. This is the first step, right? Biotechnology, medtech, with respect to the patent box. We've seen these sorts of regimes in other countries, and they work very well, provided they continue to be supported and given the opportunity to expand. Tax cuts of nearly half of the current higher corporate tax rate are concessional, are incentivising in the space. So I hope that we can see an expansion and move and continue developing in the space of innovation, which then leads to sustainability and environmental technical issues being supported. I mean, it's a fair question. There wasn't a lot in the budget that specifically touched on it, given the amount of discussion leading up to the budget on those issues and the environment and climate change. So there are some specific reforms, I think, that will lead and continue to assist with innovation in that space, but nothing hard hitting in the budget on sustainability and environments at this stage, but we'd hope it
Yeah, it's interesting, isn't it? Because earlier on today I spoke about the corporate tax rate on a more broad-based sort of level around that, and the approach that the government has taken, obviously with patent box regime, is to give a concessional lower corporate tax rate for a very specific area that it wants to invest in. One of the interesting things that was in the budget didn't get that much attention, but there was previously, for many years, there was an offshore banking unit regime, and Catherine, you might be aware of this as well, but it was a special 10% tax rate that some of the banks could access for certain business they were doing. It was fairly underutilised, but interesting that we're seeing that a swing to more specific sectors. So is that an approach you could see, Brian, that might happen, rather than it being a tax cut across the board on the corporate front? It might focus on the particular sectors.
Well, I think we're seeing that play out in the budget announcements this year. There are specific, industry-focused concessions, and we'll see more of that. I mean, we're sitting here with a dual corporate tax rate system at the moment. We don't want to continue to increase the complexity around that by having different corporate tax rates for different industries, and it could be a little bit of a mess. But yeah, look, I certainly see continued focus on certain industries being the approach taken. I mean, as you said, it'll be interesting to see how it plays out in the long term. The offshore banking, they wiped that clean. The final death stroke on Tuesday night to say that no longer exists, and the withholding tax is gone, the lower tax rate is gone. So, look, as I said, I'm hopeful. We saw a lot of discussion around the digital economy and the ideas boom back in 2015. Some significant concessions were brought out then, and they're only really just starting, I think, to get takeoff, particularly around sort of the early stage innovation companies. And some of the ESS schemes that were brought out in 2015 to encourage innovation and startups. So look, the patent box is again a good next step. It'd be good to see it excel and progress.
Another question here, Catherine, for you. Where do you see the FX rate going?
Good question, and this is something else I think to note in the budget. Usually there is an assumption that it's going to stay at a certain rate, because again it's very difficult to figure out where the currency is going to go. We're expecting a bit more of an appreciation this year, perhaps getting to 82 US cents by the end of the year. I think, the Australian dollar really outperformed a lot of last year, and it's really linked with, I guess, the growth outlook for the global economy too. And obviously high iron ore prices also add to that a supportive environment too. So there are some risks though, and I guess one of the risks coming up this year is, the RBA is going to have to decide what it does with QE once we get to September and the second tranche would actually come to an end. And what it decides to do will partly depend on what central banks overseas are doing as well. So for example, if central banks, continue their QE programs on the same size and scale and timing, and if the RBA then said, okay, well actually we're not going to extend QE anymore, that would put upward pressure on longer term bond yields and would also put upward pressure on the Australian dollar too. Now, usually in this sort of environment, the RBA would like a weaker Australian dollar because it makes us more competitive. But that's been less of an issue over the past year because, Australian dollar could have dropped to 50 US cents and we're not going to attract any more students or visitors into the country. But from next year, when hopefully we do start to see borders reopen again, preferably sooner rather than later, that is going to become more of a factor too. So that I think is going to factor into the RBA's thinking on its future policy direction when it compares with what other countries are doing.
Right. Might finish up with one more question, and I'll ask you that question, Paul Gura, and I don't want to get you started here because I think you're going to have a lot to say. What are you in the chamber hoping to see in the state budget coming up?
Yeah, so around and I'll keep it brief, we made a submission to the state government and it was really well documented actually by the Herald Sun, who turned it into an editorial as well, which we're really pleased with. But it's around the three themes, growing business, enabling business and then ease of doing business. So broadly in those categories, we floated the idea, probably the most strongly that's been floated before, to remove stamp duty and replace it with an annual land-based tax. We know the Treasurer's rejected that out of hand this time around, but I suspect that conversation is now alive and well, and I think we'll hear that not next week, but I suspect we'll hear more on that over the next 12 months. We'd like to see, rather than more big builds, there's a lot of big build in this state at the moment, but planning for what occurs after that big build is complete. Support for international students, and our concept was a task force that sits and works with all the universities and TAFEs back in with the federal government to put a plan together to not only signal that Australia is open, because there is a perception internationally that we're closed at the moment. We need to get that signal out before we lose students to Canada and the UK from July onwards. Signal that it's open, but then to bring them back in as well. We'd like to see payroll tax be more competitive with the other states. The Treasurer and I discussed this at length, and whilst, yes, once you roll regional Victoria in, you could argue we're more competitive, but the honest truth is there's not many companies in regional Victoria that are hitting that level of requirement to pay that payroll tax. So let's get it in line with where the other states are to make sure that we're as competitive as what the other states are, so that we don't lose businesses to the other states. And then finally, building off a lot of the innovation that occurs in this state, make it even more possible for international companies to make Victoria their home. There's no reason why this state can't be the best state to live, work, learn and operate a business in all of Australia. In fact, in all of Asia Pacific, when you think about what's happening with Hong Kong at the moment and the opportunity that may present for Australia, Red Victoria. So it's around strengthening where we can go.
Terrific. Well, we're just about out of time this morning. What I'd like to do is invite our Managing Partner, Brendan Britton, to the stage to make some closing remarks, vote of thanks for our speakers, our great speakers today, and also, of course, to do the prize draws. So, Brendan.
Well, good morning, and thank you, Stuart, and a very special thank you to you, Catherine. Very most insightful, and I did learn a number of things from your comments today. I think the ANZ Bank is probably the number one bank to our client base. Most of our significant clients bank with the ANZ in some form or another, and the support that the bank has given our clients and many others, not just through the pandemic, but also thinking about acquisitions of capital equipment and the like over the coming years has been wonderful. So thank you for your support. Paul, as always, terrific to hear from you today. You've been the voice of Victorian business throughout this pandemic, with a whole, I think, 6 weeks in the role before the pandemic hit. You've done a wonderful job for each and every one of us here in advocating with government and supporting industry. I think another wonderful initiative that the Chamber's put together is the Victoria Summit in 2 or 3 weeks' time, which is a group of significant group of Victorian business leaders breaking out over the course of a day to make Victoria exactly what you described today. Many people say that, and Paul's touched on it today, private business are the ones who drive the economy, the engine room of the economy. And with initiatives like the Victoria Summit, Paul, that's firmly an opportunity for us to continue to drive that for not just our city and our state, but indeed our country. I really do hope that we continue to see the same level of recovery that we've seen in the last quarter. In February, we completed our Pitcher Partners Business Radar Survey, where we surveyed a significant number of middle market owners and leaders across Australia. We wanted to understand what was important to them and things that they were facing into the future. Interestingly, we'd conducted our previous survey in October 2019, pre-pandemic, and in February this year, the respondents indicated to us that their business confidence in the middle market is significantly above where it was in October 2019. Now, where we are today, that's not a surprise, but where we were in February, it was, to me at least. There are a number of challenges and opportunities that each of us have over the course of the next 12 months and beyond. That confidence, however, at least in my mind, is down to the belief in our local economy, the Victorian economy, the Australian economy, as well as the self-belief of the middle market entrepreneur, business owner. I think the budget measures, along with that spirit I just described, will continue to push the middle market's recovery efforts for our state and our country. Our survey also found that although the pandemic crippled some businesses, many operators and owners didn't let the crisis go to waste, using it to better equip themselves to adapt and meet the future challenges. And this is exactly the strength we see with so many of our clients in the room today, but also generally throughout our community. It was pleasing for me to see some budget measures aimed at assisting the middle market with talent attraction and retention. I think around 50% of middle market businesses have indicated that they have difficulty attracting and retaining quality people. I think some of the measures with regard to traineeships and apprenticeships that Paul outlined today and that were announced on Tuesday night are really important for all of us in a productivity sense going forward. Combining that with the capital allowance, the instant asset write-off measures, that allows us all to invest in future productivity, which hopefully, as Catherine told us earlier today, results in a more optimistic outcome than the government has described on Tuesday night. For now, we believe our clients in the middle market should focus on harnessing the opportunities that the recovery presents and work to re-establish, innovate and invest. Hopefully our borders open up sooner rather than later, as I think that presents a whole nother opportunity for each of us. Just as a reminder, it's important that we do remember the budget forecasts are predicated on a really complex set of assumptions that I'm sure Catherine knows very, very well. Catherine's touched on some of them today, the iron ore price and the like. As we've seen with both our unexpected strong rebound in employment and also our slower than expected vaccine rollout, expectations of timelines change very, very quickly, and these will continue to have large impacts on the short-term budgets and economic conditions. Staying flexible, efficient and productive will be as important as ever for the middle market. Now, it's been wonderful to see so many people here today in person. Particularly since Easter, there's been more and more terrific business events occurring. I think there's a real energy in the room. The connections and the face-to-face contact, I think, are just tremendous. And I'm glad that we could get you all together here today. Before I wrap up, I'll perhaps invite Catherine and Paul to help me select our door prizes, which I think are here. This is the in-person door prize, Catherine. And it's Adam Tuck from Oliver Hume. Where are you, Adam? There's a gift hamper for you at somewhere. There it is. And Paul, our online winner. It's Paul Horwath from Ryder. So congratulations. We'll get that couriered out to you shortly, Paul. Now, Catherine, you've made your debut today with the Pitcher Partners Budget Breakfast. We'll be very pleased to have you back next year. And just as a small token of our appreciation, thank you, a small gift. And Paul, again, a terrific contribution to our Victorian business community in particular over the last 12 months. We really couldn't have asked for anyone better to help our Victorian business owners through this last 12 months. So thank you for today. We really much appreciate it. Thank you. Today's session has been recorded, and we'll send that round to each of you if you'd like to share it with any of your colleagues back in the office. Thank you for joining us today, and I hope you've enjoyed your time with us, and I hope you enjoy the rest of your day. Thank you, everyone.